Welcome to this explainer. Today we're diving into one of the absolute wildest stories happening in the retail market right now. For years, Lululemon seemed, well, practically invincible, right? They didn't just sell activewear, they literally created the whole athleisure category. They commanded premium prices, built unbelievable brand loyalty, the whole shebang. But man, has that narrative shifted violently. So today we're doing an objective deep dive into the absolute collapse of Lululemon's stock. We're going to look at the fundamental data, the shifting consumer sentiment, a bit of spicy boardroom drama, and some conflicting valuation models, all to answer one massive question. Is this a once-in-a-generation buying opportunity, or are we looking at a classic value trap?
Okay, let's dive right into this, because this number, it's just staggering. Down 60%. Over the past year, Lululemon stock has completely plummeted from its 52-week highs, basically wiping out tens of billions of dollars in market value. And look, this isn't just a minor pullback or some broader market correction we're talking about. We are talking about a stock that was trading comfortably in the high 200s, even briefly pushing past $400 not too long ago. Now, it's battling multi-year lows. When a blue-chip growth darling like this loses more than half of its value, well, it forces every single investor to ask, what on earth broke?
Section 1. The Great Lululemon Crash.
So to really understand how we got here, we've got to look at the immediate catalyst, which was their recent financial updates. Earnings reports are kind of the ultimate truth tellers for a company's momentum. And Lululemon's latest release, it sent absolute shockwaves through the market, triggering an immediate 11% drop overnight in aftermarket trading. But here's the crazy part. At face value, the market's panic actually seems pretty confusing. Q1 2026 actually beat Wall Street's consensus. Revenue came in at $2.47 billion, topping the $2.43 billion expected. And adjusted earnings per share, $1.69, just edging out that $1.68 estimate. So they beat on the top line, they beat on the bottom line. Why the massive sell-off? Well, as we see all the time in the markets, it's not really about where you are, it's about where you're going. Let's see how this builds into a much, much darker picture for the rest of the year. See, the market completely panicked because management heavily slashed their forward-looking guidance. They cut their full year's sales outlook to a range of $11 to $11.15 billion, which is way down from their previous, way more optimistic forecast. They also slashed their earnings per share guidance. But the absolute gut punch? That was their warning for the second quarter. They're actually expecting North American sales to fall by a low double-digit percentage. And for a company whose entire growth story has been built on dominating that North American consumer, a double-digit contraction is a glaring, flashing red flag.
Section 2. The bear case. Stretch thin.
Now, critics are arguing that Lululemon isn't just facing some temporary macroeconomic speed bump. No, they're facing fundamental, structural headwinds that are just crushing the brand's momentum. The argument here is that the brand is literally stretched too thin, fighting off an absolute onslaught of competition and rapidly shifting consumer tastes. And honestly, nothing captures the erosion of a premium brand's moat quite like consumer sentiment. Take a look at this quote from a retail investor on the value investing subreddit. They pointed out that Costco pants, Costco, have almost entirely replaced their Lululemons for 1/6 of the price, saying they're about 90% as good. I mean, wow. When your core consumers start realizing they can get near-identical quality for a fraction of the cost, your pricing power just evaporates. Plus, the athleisure market that Lululemon practically invented, it is hyper-saturated now. Brands like Alo Yoga and Viore are outmaneuvering them, capturing that in-season hype and the whole quiet luxury aesthetic people are chasing right now. Even Lululemon's own management admitted their recent product lines have gotten a little stale.
And when products get stale, the financials really start to bleed. Notice how their profit engine is kind of breaking down right now? Gross margins contracted by a massive 410 basis points. That's 4.1%, dropping down to 54.2%. So why the squeeze? It's a devastating 1-2 punch. First, a sudden change in U.S. trade policy slapped them with a whopping $240 million tariff bill this year. Ouch. Second, because those new product launches failed to really ignite sales, the company is being forced to lean heavily into markdowns and clearance sales just to move inventory. And look, slashing prices is the absolute quickest way to erode a premium brand's equity, and it eats directly into their profitability.
Section 3. The bull case. International savior.
Now, what's really interesting about this next part is that despite all the doom and gloom, the bulls are absolutely refusing to get up on this stock.
Every company goes through difficult product cycles, right? And the optimists out there believe the market is severely overreacting to the weakness here at home while totally ignoring a massive growth engine that is firing on all cylinders overseas. Because while North America is definitely stalling, with America's comparable sales down 5%, which, by the way, marks the 5th consecutive quarterly decline, a completely different story is unfolding elsewhere. Over in China, revenues surged 30% in Q1. That is incredible. And that performance is driving their overall international growth up 22%. So the entire bullish thesis really rests on this idea that China and the broader international market will step in as the company's ultimate savior, basically carrying the weight while they fix their issues back home.
And to be fair, the bulls have some incredibly strong fundamentals to back up their patience. We need to be clear, this is not some distressed company on the verge of bankruptcy. Not at all. They are sitting on an absolute fortress of a balance sheet, with $1.8 billion in cash and zero debt. Zero. And they're using that massive cash flow to aggressively buy back their own stock. They've actually retired 4.4% of their outstanding shares since Q1 of last year alone. Plus, there's a highly anticipated leadership change right on the horizon. Heidi O'Neill, who is a Nike veteran with a really proven track record of building women's businesses and shortening product lead times, is stepping in as CEO this September. The Bulls firmly believe she is exactly the visionary needed to come in and completely refresh the brand.
Section 4. Resolving the boardroom drama.
But before any new CEO can step in and fix the products, they really need a clear runway. Luckily, a major development just went down behind the scenes that removes a very ugly, very public distraction for the executive team. For months, Lululemon's eccentric founder, Chip Wilson, had been waging this incredibly loud proxy fight. He was out there publicly criticizing the brand, the board, the company's overall direction, just creating a massive headache for executives and making investors super nervous. But they finally reached a truce. Wilson gets 2 board seats for his side, and in exchange, he pauses all his public criticism. This is just a massive, massive win for the incoming CEO. It means she doesn't have to fight a war in the boardroom on day one. She can focus entirely on cutting that product development cycle down from 24 months to 12 months and just get the business back on track.
Section 5. Valuing a fallen giant. So we know the bear case, we know the bull case, and we know the boardroom is finally stable. This brings us to exploring what this stock is actually worth today. And listen, valuing a fallen growth stock is arguably one of the hardest things to do in finance, because you have to figure out if the market has overcorrected. And this brilliantly illustrates that exact dilemma. Look at these multiples. Lululemon is currently trading at a price-to-earnings, or PE ratio, of just 10 times. Compare that to the broader retail sector average, which is sitting at 16 times. Historically, Lululemon has always traded at a massive premium because everyone viewed it as this elite growth company. Now, it's trading at a rare, deep discount compared to boring, everyday retailers. For value investors, seeing a highly profitable, cash-rich brand trading at 10 times earnings absolutely screams bargain. But for the skeptics, it screams value trap. This table here from Simply Wall Street perfectly captures the intense tug-of-war happening in the market right now. On one side, you've got the bull narrative. This model calculates a fair value of $150, suggesting the stock is nearly 24% undervalued right now. The core rationale here is that Lululemon still boasts a software-like 24% return on invested capital and still generates a massive $920 million in free cash flow. But then, right next to it, you have the strict discounted cash flow, or DCF model. This model strips away all the emotion, calculates the present value of the cash they'll generate in the future, and heavily penalizes the company for its slowing growth and margin compression. And what does it spit out? A fair value of just $79.49, meaning even at today's completely battered prices, the stock might actually still be overvalued. So the crucial point is this. Your view on Lululemon really comes down to which side of consumer psychology you believe in. Do you believe that Heidi O'Neill can leverage $1.8 billion in cold hard cash and booming Chinese demand to reinvent the product line and return this company to its former glory? Or do you believe the athleisure space is just permanently commoditized now, and brands like Vori and, yes, Costco will continue to chip away at Lululemon's margins until it's just another average mall retailer? The data is all right here, but the ultimate fate of this athleisure giant? Well, that is entirely up to the consumer. Thanks for joining me on this explainer, and keep exploring the numbers.